Welcome to the Deep Dive. This is where we really try to unpack important concepts, pull back the layers, and get straight to what you need to know.
hmm
Today, we're tackling something pretty fundamental, actually. It's all about understanding if a business is, well, making money.
The bottom line, really.
Exactly. So this deep dive is focused on Part 3 financial documents. That's from Unit 3 Business Finance. And we're zooming in on Chapter 29, the Statement of Comprehensive Income.
A really key document.
Yeah, absolutely. Imagine you start a small business, maybe selling things online or offering some local service or making sales, money's coming in. But then end of the month or maybe end of the year, you look at your bank account, you look at the bill.
And it's not always clear, is it?
No, you're left scratching your head thinking, am I really making a profit here? Is all this effort paying off? Well, that's the question the Statement of Comprehensive Income is designed to answer. It's not just like a list of numbers. It's more like a financial story told over a specific time, usually a year.
That's right.
And it helps you figure out if your business is profitable and, crucially, how it got there.
Absolutely. You can think of this statement as like the business's financial scorecard for the year.
A scorecard, okay.
Yeah. Its main job, its primary job, is to calculate the business's profit or loss sometimes. It pulls together all the income the business generated
Right.
and matches it against all the costs it had during that exact same period.
Yeah.
Without this document, it's incredibly difficult for a business owner or really anyone interested to get a clear picture of how things are going financially.
Okay, so it's the scorecard. But looking at the source material, it doesn't just give you like one final number at the very bottom, does it? It seems to break things down. There's a process.
There is indeed. Yeah, the structure is actually quite clever. It's designed to show profitability in stages.
So stages, okay.
Yeah, revealing different things about the business's performance along the way. It usually follows a two-step calculation. First, you work out what's called gross profit.
Gross profit.
And then using that number, you figure out the operating profit. And each step tells you something different, something valuable.
Okay, let's dive into that first step then. Gross profit. What numbers actually go into calculating that? And what does that first level of profit tell us?
Right. So gross profit is calculated using just two main figures: the business's revenue and its cost of sales.
Revenue and cost of sales. Got it.
Revenue is, well, pretty straightforward. It's the total money the business earns from selling its goods or services during that period.
So the total sales value coming in?
Exactly, the top line number, usually excluding things like sales tax or VAT if that applies. It's the income from the core business activity, the trading.
Okay. And cost of sales, that sounds important.
It is. And this is where the first really crucial distinction comes in. Cost of sales is only the direct cost of getting those goods or services ready to be sold.
Direct costs. What does that mean exactly?
Well, if you're selling physical products, think about what it cost you to buy that inventory in the first place. Or if you make things, it's the raw materials and the direct labor, the wages of the people actually making the product.
Ah, okay.
The source gives good examples, like for a manufacturer, say, Walnut Soaps. It's the cost of their oils, their fragrances, and the wages for the workers mixing and packing the soap.
Right. Directly tied to making the soap.
Precisely. Or for a retailer, like the Doha Food Store example, it's simply the cost they paid their suppliers for the groceries they then sold. It's the cost that, tends to go up and down pretty directly with how much you sell.
Okay, so gross profit then is basically what I sold everything for, minus what it cost me directly to either buy or make those specific things I sold.
You got it.
So it's kind of the profit margin just on the product itself before you even think about rent or marketing or office staff.
Exactly right. The calculation is simple. Revenue minus cost of sales equals gross profit. And this figure is, well, it's incredibly insightful.
Why is that?
Because it tells a business owner, straight off, okay, am I making money just on the items or services I'm selling after I account for their direct cost? If your gross profit is low or worse, negative.
Ouch.
Yeah, it's an immediate red flag. It signals there might be an issue with your pricing, maybe, or the cost you're paying for your stock or materials, or perhaps it's about efficiency in production.
That makes sense.
If you look at that Doha Food Store example in the source material, their revenue was US $256,400.
Okay.
And their cost of sales was US $137,100.
Okay.
And their cost of sales was US $137,100.
Exactly. US $119,300. That's their gross profit. That's the profit generated purely from the buying and selling of groceries. It shows, the basic strength of their retail margin.
Okay, gross profit makes sense now. It's tightly focused on the product's profitability. But like we said, running a business involves so much more, doesn't it?
Oh, absolutely.
There's rent, electricity, maybe salaries for office staff, marketing budgets, all those costs you have, even if you don't sell much that month. How does the statement deal with those? Right, and that's exactly where the second step comes in calculating operating profit.
Okay.
Once you've got that gross profit figure we just calculated, you then subtract all the other sort of normal costs of running the business day to day. These are often called expenses or sometimes overheads. The source calls them administrative expenses and other operating expenses.
Expenses, overheads. So these are the indirect costs.
That's the key difference. Yes, indirect. They're not directly tied to producing or buying one specific unit you sold, but they are absolutely essential for the business to function.
Like what? What are some examples?
Well, the source lists quite a few, things like rent for the shop or the office, utility bills, electricity, water, salaries for admin staff, people not directly making the product.
Right, like accountants or receptionists.
Exactly. Marketing and advertising costs, insurance, and just general office stuff like stationery, maybe telephone bills. These costs tend to be more fixed, at least in the short term, compared to cost of sales.
Okay, so operating profit gives you maybe a more realistic picture of the day-to-day profitability.
I'd say so, yes. It takes the profit you made just from selling the goods or services, that's the gross profit, and then it subtracts all those other costs involved in actually operating the business. The calculation is gross profit minus expenses equals operating profit.
Gross profit minus expenses.
And this is a really critical figure. It tells you how profitable the business is from its core operations after you've accounted for all the necessary running costs, both direct and indirect.
Okay, let's go back to that Doha food store example. Their gross profit was US $119,300. What were their expenses?
Their expenses were US $77,900.
Right, okay. So US $119,300 minus US $77,900. That comes down to US $41,400.
Correct. That's their operating profit. And notice that's quite a drop from the gross profit number.
Yeah, it really is. It shows just how much those overheads, those expenses impact the final operating result.
It does.
Wow, seeing that difference between the gross profit and the operating profit for Doha, it really highlights the impact of those overheads. It makes you wonder, is their rent high? Or maybe admin costs are creeping up.
Exactly.
This distinction feels really powerful. It helps a business owner or a manager figure out where potential problems might be. Like, is the issue that my product's core profit margin is just too thin? That would show up in a low gross profit, right?
Right?
Or is the issue that my overheads are just too high and they're eating away at the profit I am making on sales, which would mean a low operating profit compared to the gross profit?
That's precisely the insight this two-step structure provides. Operating profit is often seen as a really strong indicator of how well the management team is controlling those day-to-day costs. It shows the profitability before you consider other things that aren't strictly part of core operations, like, say, interest paid on loans or taxes owed to the government. Understanding that difference between gross and operating profit helps you diagnose the business's financial health much more accurately than just looking at, one single profit number at the very end.
Okay, great. So we've really unpacked what the statement is, its purpose, and these two key levels of profit, gross, and operating. But why? Why do businesses go through all this trouble? How do they actually use this document, these numbers, in the real world? How does it help them make decisions?
Yeah, and this is where it gets really practical. This statement isn't just, an accounting exercise. It's a vital tool for making strategic decisions. The source material actually outlines several key uses.
Okay, like what?
Well, one major way is for investment decisions. Think about it. If business is performing well, showing healthy gross profit margins, a solid operating profit.
It looks good, right?
Exactly. It makes them look much more attractive to potential investors, or maybe banks they need a loan from. People putting money into a business want to see proof that it's profitable, that it's growing. A strong statement of comprehensive income provides that proof.
It makes it easier to get funding.
Definitely. And on the flip side, a statement showing losses or, shrinking profits can make it really hard to attract investment.
Right. So it's like a CV for the business's financial health, basically. Investors check it out.
That's a good way to put it.
Yeah.
Another crucial use is cost analysis and control.
We touched on this a bit.
We did. As we saw with Doha, Seeing those different cost buckets laid out, cost of sales separate from expenses, lets businesses see exactly where their money is going.
Pinpoint the issues.
Precisely. If gross profit is falling, they know, okay, we need to look at our supplier costs or maybe how efficiently we're making things. If operating profit is low, even with a decent gross profit, they know the investigation needs to focus on the overheads.
Rent, marketing spend, admin salaries.
All of those. Are rent costs going up? Are we spending too much on marketing for the sales it brings in? This breakdown helps them find the problems and, importantly, take targeted action to cut costs or boost efficiency.
Makes sense. What else?
It also provides a really fundamental basis for future forecasting and planning. Businesses don't just look backwards.
They need to plan ahead.
Absolutely. They use this historical data to try and predict the future. If the statement shows profit has been growing steadily year after year, well, the business can reasonably forecast that growth might continue.
So they can budget accordingly, maybe hire people, buy equipment.
Exactly. Plan for expansion. The Rolls-Royce example in the source, the one showing data over 2 years. That illustrates how businesses track these trends. Public companies especially use these statements to give forecasts to their shareholders about expected future profits.
Okay. Forecasting, got it. Anything else?
Yes, one more key use, making comparisons. This is really important for context.
Comparing to what?
2 main things. First, comparing their current performance to their own past performance, like comparing this year's operating profit to last year's. You see this in the Walnut Slopes table and the Rolls-Royce one too.
So are we improving, getting worse, staying the same?
Exactly. Are we getting more efficient or less? And second, they can compare their performance to competitors, assuming that information is available, which it often is for public companies.
Benchmarking.
Precisely. How do our gross profit margins stack up against others in our industry? Are overheads higher or lower than the average? This kind of comparison helps them understand their position in the market. Are we doing well relative to others, or do we need to catch up?
It really is like you said, a comprehensive health check, isn't it? Not just looking at the final number, but all these different layers. Helps diagnose issues, attract money, plan for the future, see how you measure up.
Absolutely. Each number tells part of the story, and seeing them together gives that fuller picture of how well the business is actually turning sales into real profit from its operations.
All right, we've covered quite a bit there. What the statement is, gross profit, operating profit, what they mean, how businesses use them. It feels like a good time to maybe test ourselves.
Yeah, let's solidify some of that. A quick check.
Okay, just a couple of questions based only on what we've discussed from the source. Ready?
Let's do it.
Okay, first one. Think about those calculations. A business has revenue of US $239,500. Cost of sales is US $154,000, and expenses are US $65,000. So what's the value of the operating profit? Is it a US $20,500, B US $85,500, C US $393,500, D US $239,500? Think it through. Okay, here's another one. Thinking more about how these statements get used. A statement of comprehensive income might be used to do which of these? A, calculate labor turnover. B, help make investment decisions. C, measure the value of assets in a business. D, calculate the liquidity ratio. Remember those 4 key uses we talked about just now for decision making? Which one fits here? Right. And maybe one more, focusing on the sort of fundamental point of it all. Which of the following is a function of profit itself? A measure of global economic success. B, used to calculate the break-even point. C, measure of business performance. D, measure of labor productivity. Just take a moment. Think about why profit matters to a business based on our chat.
Good questions.
Hopefully those get you thinking. So just to quickly recap, we've taken a deep dive into the Statement of Comprehensive Income. It's that foundational financial document.
The scorecard?
Yeah, the scorecard. We learned it's the key tool for calculating a business's profit over a period, and it does this in stages. First, gross profit.
Which is revenue minus the cost of sales.
Yeah.
Showing that core profitability of what's being sold.
Right, and then you take that gross profit and you subtract the expenses.
The overheads, the running costs.
Yeah.
To get the operating profit, which gives you that clearer picture of how efficient the overall operations are.
And crucially, we saw these numbers aren't just looked at and filed away. They're actively used.
Really important point. They're used to attract investment, to analyze and control costs,
to plan and forecast for the future, and to compare performance against yourself over time and against your competitors.
Understanding these numbers, and importantly, the story they tell, is just essential for anyone involved in business.
Yeah.
Whether you're running one, thinking of investing in one, or, like many of you, studying business.
Absolutely. And if you do want to explore this topic more or find other resources for IGCSE business studies, remember you can check out www.igcsetouchbusiness.weebly.com.
Yeah, definitely worth a look. And maybe just a final thought to leave you with.
Go for it.
The statement lays out the numbers, right? Gross profit, operating profit. But the real insight, the real deep dive, if you like, comes from asking why.
Why the numbers are what they are.
Exactly. Why was cost of sales so high this year? Why did our expenses suddenly jump in the second half? Asking those why questions forces you to look beyond the figures on the page and understand the real-world things happening. The challenges, the decisions, the actions the business took, the numbers are really just the starting point for digging deeper into performance.
That's a fantastic way to frame it. The numbers guide the questions you need to ask next. Brilliant. Well, thanks for joining us on this deep dive.
My pleasure.